Good morning, everyone, and thank you for joining us today. My name is Jason Cogdell, and I'm the benefits attorney at ProBenefits. This is the second in our mini webinar format where we take a core benefits topic, or in this case, a popular benefits topic, and try to cover it in about 15 minutes. The goal is to interrupt your schedule as little as possible. Obviously, with topics like this, there's only so much you can say in 15 minutes, so the goal is really to provide you a helpful overview of the topic, and that's what I want to do today on a topic that is hot and has been hot for a long time, and that is employer reimbursement of individual insurance premiums. We are going to provide you a copy of the slides. There's a lot of information here on only about 5 or 6 slides, so we'll provide you a copy of the slides so you can focus on how this may impact your organization, or if you're a plan advisor, your client organizations. I'm going to get to some questions during the webinar. Chris McCauley's assisting me today. He's going to cover some questions. If you want to submit a question to us later, that's fine. I'm not going to stop and cover questions in the interest of time, because I really want to give you all an update of kind of where we have been and where we are, including some recent updates regarding this very, again, popular and controversial topic. So I'll just launch right into it. First, I thought it'd be helpful to provide you some context. Without question, the ACA has had a significant impact on everything that relates to employer-provided insurance. That includes group plans, that includes supplemental plans, it includes basically any health type of benefit that can be provided by the employer, because the compliance analysis for all of those plans has changed. Now, importantly, as we set the context for the individual reimbursement topic, we need to talk about what has not changed. And first of all, there is no change for employers that have group plans. The employer contributions are still fully 100% deductible, federal, state, and FICA, and any deductions paid by the employee with the employee payroll dollars deducted on a pre-tax basis are exempt from federal, state, and FICA. And oh, by the way, the employer gets the FICA savings on the employee contributions. No change to any of that. Also, secondly, in an item that has come up a lot recently, what if an employer wants to allow employees to go on their spouse's group plan, but the employer wants to pay the spouse taxable income to help offset the contributions that spouse pays toward his or her group plan? Can the employer do that? Yes. No change here. Now, what the employer provides the employee, as listed at the bottom of that slide, needs to be taxable income. The reason for that is that spouse is paying those group premiums with pre-tax dollars through spouse's payroll deductions in Section 125 plan. So the employer reimbursing the spouse, our employee, for premiums paid toward spouse's plan needs to be taxable, but no change here. These rules do not apply. Another note, the new changes in the law do not apply to retiree arrangements. Employers can reimburse individual coverage for pre-65 retirees or Medicare supplement coverage for post-65 employees. No change to the law for retirees. We're only talking about employers reimbursing individual health insurance coverage for active employees, or reimbursing individual coverage for the spouses or dependents of employees. And for this purpose, individual coverage does include individual coverage purchased from a carrier, such as, we're in North Carolina, so Blue Advantage coverage purchased from Blue Cross Blue Shield of North Carolina. It also includes Medicare supplement coverage, which is essentially individual coverage, and any coverage purchased through the health insurance marketplace. One of the questions that I've received a lot in the last couple of weeks since this latest release by the government is why? Why does the government care? That's an excellent question. I think the short answer is that the government doesn't want employers dumping group plans and dumping the risk and the employees on the marketplace. Or if the employer does it, the government doesn't want the employer or employees to get tax advantage coverage that way. So I think that's the best short explanation of what is a very complicated policy issue. Now, as some further context, employers have been reimbursing individual premiums for a long time. There's no question about it, and no one can dispute it. This has primarily been a practice of small employers. A lot of nonprofits have done this, a lot of churches. My own church has been doing this until recently, when we had to go away from it because of the changes in the law regarding taxability and risk for employers. Now, traditionally, employers have done one of two things. They have either allowed the employee to go get their individual coverage and the employer just reimbursed that coverage tax-free to the employee, or the employer allowed the employees to go and then the employer paid the carrier directly and didn't add that to W-2 income. That's kind of the direct pay option, the list bill option, as many people call it. I would say that probably more employers use the reimbursement option, but it was somewhat close to 50-50. This has always been allowed, as reflected on the slide. The IRS said in 1961, IRS Revenue Ruling 61-146, that an employer could pay for health or accident premiums, individual coverage of an active employee, and reimburse those on a tax-free basis. And that was true whether the premiums were paid directly to the carrier or whether the employee went and got the coverage and the employee was reimbursed by the employer. So that has been allowed for 50 years, and IRS Revenue Ruling 61-146 has never been overturned. So this is what small employers, churches, and other employers have relied on, whether they were doing this for one employee or 50. This is the revenue ruling they were relying on. Also, health reimbursement arrangements, which really came on the scene beginning in 2002, on paper can reimburse individual premiums, at least pre-ACA. So some employers would establish a health reimbursement arrangement and allow employees to go get individual coverage either for themselves, spouse, or dependent, and then the HRA would reimburse that coverage. Importantly here, a factor is that the IRS code has not been formally amended. So some employers are getting answers from their CPAs to say, yes, the IRS code still allows it. This can be done on a pre-tax basis, and that is correct if you just look at the IRS code. So what we're dealing with is not the IRS code now, but the new ACA rules, which say that the employer cannot do this without incurring potential risk, and that risk is significant. It's $100 per day per employee penalty under the ACA's general noncompliance penalty. Now, that would only apply if an employer was involved in the payment or reimbursement of individual premiums for active employees, and that arrangement, which is known as an employer payment plan if it's done directly by the employer outside of an HRA plan or any other benefit arrangement, was scrutinized by the IRS or DOL. So it's not that there's an automatic penalty. It would have to be scrutinized or reviewed. Also, something I won't get into today, but employers reimbursing individual premiums should realize that there are secondary considerations. As an example, if scrutinized by the Department of Labor may rule that the employer has effectively rebuilt a group plan with individual policies, which would implicate ERISA, HIPAA, and COBRA, and some items that the employer may not have intended to deal with when it sought to just reimburse employees for individual coverage. So that is the context of the issue. Now, I'm not going to go through the painful process of what has been the last 2 years and 1 month of guidance on this. It started in January of 2013, and it continued through 2 weeks ago when the IRS released Notice 2015-17. Here's the short story of this slide, which we'll provide you. The short story is this, that under the ACA, the agencies have said that if the employer seeks to have any involvement in the payment or reimbursement of individual premiums, this is whether it's done pre-tax or post-tax, whether it's done by reimbursement method or list bill to the carrier, whether it's done for 2 employees or whether it's done for 100, that this creates a plan that's subject to the ACA, and it fails ACA compliance because the government says the employer can't use its method of reimbursement to integrate with an individual plan to satisfy the ACA rules. The individual plan would meet the ACA rules on its own, but not in the employer context. And the key issues there, the annual and lifetime limit rule and then the preventive care mandate. So I'm not going to get into that more, but the short answer after we move past all the legal analysis is that the employer just can't have any direct involvement. That means reimbursement even with taxable income. That means list bill. That means HRA. And that any employer involvement could implicate the ACA risk, which I think employers want to avoid. And so that, I think that's the key compliance issue. Now, again, when we look at exceptions, and I mentioned a moment ago, retiree arrangements are not affected here. And also, as confirmed by the recent guidance, there is effectively a fewer than 2 exception because it generally takes 2 employees to create a plan that's subject to the ACA or ERISA. So technically, and within a loophole, if an employer is doing this for only 1 active employee, then that would not be subject to the new rules. The employer could do it, could even do it on a tax-free basis, although there's still some secondary considerations there, so I wanted to bring that to your attention. So where does that leave us? We thought we had the picture fully clear, and then 2 weeks ago the IRS released Notice 2015-17. I would recommend that if you are an employer reimbursing premiums now or considering it, or if you're an advisor that has clients doing this, I would recommend a read of 2015-17, which we'd be happy to share with you. It basically does three things. Number one, it gives limited transition relief for small employers that have been reimbursing individual premiums. This relief applies for all of 2014 and through June 30th of this year. So if you're a small organization, you're reimbursing individual premiums, whether on a tax-free basis or taxable, this effectively means you have no risk through June of this year. Now, the risk is going to be there starting July 1, so you need to consider that and potentially make a change going forward. But you've got transition relief, so you would not, the employer could not be penalized for 2014 and the first 6 months of 2015. That's a huge deal. Now, it does apply only to employers with less than 50 full-time employees plus equivalents. Effectively, that means the employers that are not subject to the employer mandate. Also, no change for 50-plus employers, and this doesn't create a grandfathered scenario. So one of the questions I received this morning was, if we start doing it now before June 30th, would that allow us to do it for 1 year? No. This means a flat, hard stop at 6:30, and anything past 6:30 could create some potential risk. Notice 2017 also provided some transition relief for S corporation owners reimbursing individual premiums for, S corporations reimbursing premiums for the S corp owners, which is an interesting tax topic and we won't get into today, but just know there's some transition relief. We can provide you some additional information there. And then also employers reimbursing Medicare Part B, D, or TRICARE premiums get transition relief as well. But the big piece is that number one, that small employer. So the good news is if you're a small employer still reimbursing premiums, this is a get out of jail free card for 18 months and removing that risk, and you've got a window now to make changes. If you were previously doing this but have already made the changes to be compliant, you're in good shape, and theoretically you could have waited to do it later, but we had no way to know this. This was a very surprising and in my view, unexpected grant of transition relief for small employers. And the next question is, could the law change? Could there be a permanent exemption for small employers? Maybe so. I think that's very possible, but that's not going to happen right away, so it's something we certainly can't count on. Now, where does this leave us? This leaves us with some options, yes, but again, the key story here is no matter what somebody else out in the marketplace may be saying, and there's still loud voices out in the national perspective saying that employers can find a way to do this, it's just not true. But here's the big picture perspective. The employer should not be directly involved in the employee's purchase or payment of individual premiums. So no list bill, no reimbursement, even if taxable, no requirement that employee, if you go get individual coverage and you prove to us that you have it, will increase your income. No, an employer cannot do that. Any of those would subject the employer to risk, and there's no one of those ways that's better than the other. They are all non-compliant. Now, here's what an employer could do. First of all, as listed in the last bullet point, an employer could discontinue its involvement, tell the employees, we're going to adjust your gross income, whether or not you go get individual coverage, go on spouse's plan, get no coverage, we're going to adjust your gross income, and we don't want to know what coverage you have. An employer can do that, and the guidance from 2 weeks ago clarifies that. Another option, the employer, particularly a small employer that hasn't looked at the group health insurance option, well, could implement a group health insurance plan. This is what my church did. And after over a decade of reimbursing individual premiums, when we had to make a change, we reassessed a group plan, went with a high deductible plan for our church staff. It ended up being cheaper for us to get a group plan with the tax savings than it was to continue to reimburse individual coverage on a taxable basis. So I think that's an option that small employers will want to take a look at. It won't be for everybody. Cost is a factor, but that is something that may be an option there for you. And then third, employers could continue their current practice and remain involved with reimbursement of individual insurance and just accept the ACA risk and know that you're okay from an IRS perspective, tax-wise, but you have ACA risk. I wouldn't recommend this, even though an audit of most small employers is unlikely. The risk is just too significant, if this were scrutinized, and we just don't know if the law will change. So I feel like small employers need to make the change. But until then, no list bill, no send the employee out for individual coverage and then, reimburse it either with taxable or non-taxable dollars. I feel like the best thing an employer can do is just not be involved. So that is where we stand, and that is a very brief and probably an overly fast in terms of the speed of my voice overview of what is a complex issue, but we just wanted to provide you this information. Now, we'll provide you a copy of the slides, and we'll provide you a copy of Notice 2015-17 in case you don't already have it. If you'd like to see, I'm going to flip back a couple of slides, if you'd like to see the FAQ that the agencies issued in November, which was very helpful, we'll be happy to provide you a copy of that as well. Of course, you can access any of these items that are listed on the screen by searching them via Google or on the IRS website. So we're getting a few questions in here, but in the interest of time and shutting this off on time, I'm going to go ahead and stop there. Thank you for joining us today, and we will be in touch. Feel free to keep submitting your questions, and we'll get back to you. Thanks, and have a great day.